Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023 October-November Paper 4-3 question number 2. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. The directors of W Limited are considering the purchase of a specialized machine, IM, to manufacture a product which has a product life of 3 years. And they have 2 different options. So the first one is to buy an old model IM3, which is a used machine, and a major improvement on the machine is required if it is bought. Okay, there's also an improvement cost required, and W Limited has experience of using this model in the past. The second option is to buy the most recent model IM8, which is a new machine. The variable operating cost is 4.80 per machine hour and is the same for either machine. Both machines will be depreciated using the straight line method with no residual value, and the selling price is 52 per unit. We are given the estimated sales in units for 3 different years, and that's the lifetime of this particular project or this machinery. And further information is also available. Okay, so the maximum annual production capacity in units is given for both of our machines, IM3 as well as IM8. So for IM3, it's 15,000, and we can see that in year 2, our estimated sales in units is 18,000. But since this machine can only produce 15,000 maximum units, if we are calculating for the machine IM3, then for year 2, while calculating our variable operating cost as well as calculating the revenue, we need to include the units as 15,000 and not 18,000 because the machine itself will not be able to produce the 18,000 units. But for IM8, we can see that the maximum annual production capacity is 20,000, which means that for the year 2 estimated sales of 18,000 units, it can easily be produced by IM8. And we are given the purchase price of each of the machineries. We are given the cost of improvement as well. Okay, so these two will be a part of our initial outlay, which means that these are the costs that will have to be borne by the company at the starting time, which is year 0. Then we have the machine hours per unit as well. And this is important for our variable operating cost because it is given per machine hour. Then we have our annual fixed overheads, but this includes depreciation as well. And remember, whenever we are talking about investment appraisal techniques, we majorly focus on net cash flows. So in such calculations, we need to exclude the non-cash expenses, which means that we need to exclude the depreciation. So let's figure out the depreciation per year for both of these machineries. And remember that we were told both machines will be depreciated using the straight line method with no residual value. So we can just divide the initial outlay by the number of years, which is 3 in this case. So for our machine IM3, our initial outlay is 141,000 plus 57,000, which is 198,000. Let's divide it by 3. This gives the depreciation per year of 66,000. We repeat the same process for IM8. We have the initial outlay of 420,000. We divide it by the number of years, which is 3. And this gives the depreciation charge per year of 140,000. And remember, we need to exclude this depreciation per year from our annual fixed overheads, which means that we just need to subtract these values from the annual fixed overheads while incorporating the fixed overheads for the calculation of net cash flows. That is all for the given information. Let's start with the first part. We now need to prepare a statement showing the net cash flow for each year from year 0 to 3 for model IM3. So that's our first option. So we have 0, 1, 2, 3. Okay, wait. Let's include 2 rows for our headings. The first thing that we can consider is the initial outlay. This is the amount paid at year 0. And for machine IM3, that is just going to be 141,000 plus 57,000, which results in 198,000. Then we can include our variable cost or the variable operating cost. And in order to calculate the variable operating cost, we have been given the rate per machine hour. So firstly, we need to calculate the rate per unit. So in order to do so, we just have to multiply this rate of 4.80 to the given machine hours per unit. So that is just going to be 4.8 times 5, which results in 24. So that's the variable cost per unit. And now, in order to calculate the total variable cost, we just need to multiply this to the number of units. So for year 1, that will be 12,000 times 24, which results in the value of 288,000. Let's write it down. And this is the cost, which means that this will be our outflow. So let's subtract it. Now we need to repeat the same process for year 2 as well. But remember that our maximum annual production capacity is 15,000 for IM3. So rather than 18,000, we'll be using 15,000 units. So that will be 15,000 times 24, which results in the value of 360,000. Then we repeat the same process for year 3 as well. The number of units given in this case is 10,000. So that will be 10,000 times 24, which results in 240,000. Okay, then we also have the fixed overheads. And for the fixed overheads, we are given the amount, but this includes depreciation as well. Now we just need to subtract 66,000, which is the depreciation charge per year, from this 327,000. So that just gives the amount of 261,000, and that's going to remain constant for all 3 years. So we just need to subtract 261,000 as the fixed overhead for all of the years 1, 2, and 3. Now the final thing we can add is going to be our sales revenue. And we were told that the selling price is 52 per unit. So in order to calculate the total sales, we can just multiply the units given by 52. So for year 1, that will be 12,000 times 52, which results in 624,000. And remember, sales will be part of our cash inflows, so we will be adding this. Then for year 2, we utilized the units of 15,000. So that will be 15,000 times 52, which results in 780,000. And for year 3, that will be 10,000 times 52, which results in 520,000. Now we have incorporated all of our cash inflows as well as cash outflows, so we can easily figure out the net cash flows now. So for year 0, that is just going to be negative 198,000, which is our initial outlay. Then for year 1, that will be minus 288,000 minus 261,000 plus 624,000, which results in 75,000. For year 2, that's minus 360,000 minus 261,000 plus 780,000, which results in 159,000. And for year 3, that's 240,000. Sorry, that's minus 240,000 minus 261,000 plus 520,000, which results in 19,000. That is all for the first part. Let's move towards the second one. We now need to repeat the same process for our second model, which is the option 2 one. Okay. So we have year 0, 1, 2, 3. Again, we can start with the initial outlay. And that's the purchase price of the machinery. For IM8, that is just going to be 420,000. The next thing that we can include is our variable cost. And the variable cost per hour will remain the same for both of the machines. So that's 4.8. Now, in order to calculate the variable cost per unit, we just need to multiply this 4.8 by the machine hours required per unit, which is 4 in this case. So that's 4.8 times 4, which results in 19.2. Now, in order to calculate the total variable cost for each of the years, we just need to multiply it by the estimated sales units given right here. So in year 1, that will be 12,000 times 19.2, which results in the value of 230,400. And this will be our cash outflow, so we should be subtracting this. Now we repeat the same process for the remaining 2 years as well. So for year 2, in this case, remember that our maximum annual production capacity is higher than all of the estimated sales units, so we do not need to incorporate this value. For year 2, it's just going to be 18,000 times 19.2, which results in the value of 345,600. Then for year 3, that will be 10,000 times 19.2, which results in 192,000. Now we can go over the fixed overheads. Again, we need to repeat a similar process by excluding the depreciation per year. So from the given annual fixed overhead of 355,000, we need to subtract 140,000, which results in a value of 215,000. And that's going to remain constant for all 3 years. And the final thing that we need to include will be our sales value. And the selling price per unit is 52 for both of these methods. So we can just incorporate the selling price that we included within the first part for year 1 and year 3. But we cannot do the same for year 2 because this included 15,000 units rather than 18,000 units. So for year 1, it will remain the same at 624,000. But for year 2, that will be 18,000 times 52, which results in 936,000. And for year 3, it's going to remain the same at 520,000. Now we can calculate the net cash flow. So for year 0, that will be negative 420,000. For year 1, that will be minus 230,400 minus 215,000 plus 624,000, which results in 178,600. For year 2, that will be minus 345,600 minus 215,000 plus 936,000, which results in the value of 375,400. For year 3, that will be minus 192,000 minus 215,000 plus 520,000, which results in the value of 113,000. This concludes the first part. Now we have additional information. W Limited uses a cost of capital of 12%. So this is the rate of interest for this given discount factor. And we need to state 2 advantages of using the net present value method for investment appraisal. So the very first advantage is that it takes into account the time value of money, since we will be incorporating the discount factor. So it takes into account the time value of money. And another advantage of using the net present value method is that it takes into account the actual net cash flows, which is more objective than profitability, because profitability will also include our non-cash expenses, which can be subjective. So it takes into account cash flow, which is more objective than profitability. Okay, now for the third part, we need to calculate the net present value for each model of machine. Okay, let's calculate it for IM3. That's our first option. We can start with our net cash flows that we've calculated in the first part. Let's copy down the amounts. So that's negative 198, positive 75, 159, and 19. Now we need to include the discount factor. And this is the discount factor given for our cost of capital right here. So that will be 1 for year 0. Then we have 0.893, 0.797, and 0.712. Now we can calculate our present values. And present value is calculated by multiplying the net cash flows to the discount factor. So for year 0, it will remain the same at 198,000. For year 1, that's 75,000 times 0.893, which results in the value of 66,975. For year 2, that's 159,000 times 0.797, which results in 126,723. And for year 3, that's 19,000 times 0.712, which results in 13,528. Now we need to figure out the net present value by adding all of these present values. So that's minus 198,000 plus 66,975 plus 126,723 plus 13,528, which results in positive 9,226. Now we repeat the same process for IM8. That's for option 2. So we have years 0, 1, 2, and 3. We can copy down the net cash flows that we've calculated in the first part. So negative 420, 178,600, 375,400, and 113,000. Again, we need the discount factors. So that's 1, 0.893, 0.797, 0.712. Now we calculate the present values. Again, the process is same. We just need to multiply the net cash flows by discounting factor. For year 0, that will remain the same at 420,000. For year 1, that's 178,600 times 0.893, which results in 159,489.8. So we can just round it off to 490. For year 2, that's 375,400 times 0.797, which results in 299,193.8. So we can just round it off to 194. And for year 3, that's 113,000 times 0.712, which results in 80,456. Now we need to calculate the net present value. And that will be minus 420,000 plus 159,490 plus 299,194 plus 80,456, which results in the positive value of 119,140. This completes the third part of this question. Now for the fourth one, we need to advise the directors which model W Limited should choose. We need to justify our answer. This is of 7 marks, so we need to have at least 6 comments. Okay, so the first thing that we can do is compare the net present value. Clearly, the net present value for machine IM8 is higher. So IM8 has a higher positive net present value than IM3. Now let's take a look at the given information. Okay, so the first thing that we can consider is that IM8 is the most recent model as compared to the old model IM3, which means that the quality of products might be better from model IM8. Let's write it down. So IM8 is a new model, and the quality of products may be better. Okay, that's the first thing. Now, what's the other? Okay, we can compare the initial outlay as well. So the initial outlay for IM3 is 198,000, whereas the initial outlay for IM8 is 420,000, which is higher. Let's write it down. So IM8 has a higher initial outlay, and due to this reason, the company might have to consider the different methods of financing for IM8. So the method of financing IM8 has to be considered. Then we can also compare the maximum annual production capacity. So the capacity for IM8 is definitely higher as compared to IM3. So if there are any urgent sales orders, then IM8 will be more efficient for the business because it can produce higher amount of units. Let's write it down. IM8 has more production capacity to meet urgent sales orders. Okay. Then we can also consider the machine hours per unit. And we can see that the machine hours required by IM8 is low as compared to the machine hours required by IM3, which means that IM8 is definitely more efficient as compared to IM3. So IM8 is more efficient than IM3. Okay, now based on these factors, we need to make a final decision. And remember that the most important factor in this case is IM3 is an old model that has been previously used by the company, but IM8 is a newer version which has not yet been used by the company. So by going with option 1, the company will not have to incur any other staff training costs, but for IM8, the staff might require training again. And due to that particular reason, I will advise the directors to choose IM3. Let's write down the decision. The directors should choose IM3 as it has been used by the company before, but IM8 is a new model which might require additional staff training costs. Okay, that's all for the fourth part of this question. Now we have been given additional information. If an additional improvement cost of 5,000 were incurred at the end of year 1, the production capacity of IM3 could be increased to 18,000 units. Now we need to calculate the change in net present value of IM3 if the additional cost is incurred. So whenever you are asked to calculate the change in net present value, you have to start by calculating the change in the net cash flows. So similar to what we did in the first part, but we will only be incorporating the changes. Okay, so we have the improvement cost of 5,000. So this is the additional initial outlay now. So initial outlay is going to increase by 5,000. That's the change. We will only be considering all of the changes in this case. Then at the end of year 1, the production capacity of IM3 could be increased to 18,000 units. And remember, by using the machine IM3, previously we could not fulfill the estimated sales of 18,000 for year 2. We could only include the sales of 15,000 units. So now, by this improvement, we can produce the additional 3,000 units in year 2 as well. So we need to incorporate the values for this 3,000 units. And the values that we need to incorporate is going to be the variable cost per unit and the revenue per unit. So let's incorporate those values as well. So we have our variable cost. And we need to calculate the variable cost for 3,000 units for year 2, right? So there's no change in year 1 and year 3. And for year 2, that will be 3,000 times 24, which is the variable cost per unit, which results in the value of 72,000. So this is the increased cost. Then we have sales as well. And again, the sales value will also be increasing for year 2. And that will be due to the increase of 3,000 units. So that's 3,000 times the selling price of 52 given in the question, which results in 156,000. Now let's calculate the net cash flows. So for year 1, the increment in the net cash flows is 5,000. No change in year 1, no change in year 3. And in year 2, that's 156,000 minus 72,000, which results in the value of 84,000. And again, we're trying to calculate the change in net present value, right? So we again need the discount factors. So that's 1. And for year 2, the discount factor is 0.797. Now the present values for year 0 will be 5,000. And for year 2, that's just going to be 84,000 times 0.797, which results in 66,948. Now we can calculate the change in net present value. That is just going to be minus 5,000 plus 66,948, which results in the value of 62,483. That's all for the fifth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.